So, welcome back to a new video. I wanted to make this video for a long time, putting everything together, everything that I learned from starting from December 2022 until now. I learned a lot of and I made money in the market, and I want to show you everything that you need, everything that you should avoid, because there's some phases a lot of people go through that are completely useless, that won't make you money. It's not easy to make money in the market, so always be pessimistic. And yeah, you should have a kind of notebook or something that you can write down things, because it will be a lot of information that you will get here. And also you should maybe watch it over a few days or something like this, because learning everything at once won't teach you things. You should just come back the next day, watch a little bit of that, then continue with that. There are also timestamps with the different things that you will learn here. So if you already know the basics, you can maybe skip that, because I will be really talking about everything, starting from zero with someone that actually never actually for like watch the video about trading. And by the way, sorry for my English. I'm from Germany. It's really hard to translate things instantly. I hope this is okay, because you will be gaining a lot of knowledge. So something to me as a person, I passed the funded account. I have a certificate, as you can see here. And yeah, I know a lot about trading, but I'm still not like a professional. I know my shit and I know what to teach people that want to make money, but I still need to get market experience, because this is the most important thing. I just didn't gain it yet, since I'm in the market for like 1 year and something. That's just not enough. Need multiple years of experience and like 10K hours or something like that. So I know my stuff, but I still can be better. I still have some losing days. Everyone has losing days, but I'm not like a professional, but I will teach you everything that you need to know to get professional and that you can follow. And starting off with the real basics, what apps you should even use. I use, wait, I'm gonna write it down. I use TradingView to analyze my charts. Just looking at the charts and finding a bias or something. You will learn that later. Just stuff that you see in the market. Then I use MetaTrader 4 or 5, whatever you prefer. That doesn't really matter. It's just design. You can just choose. I think MetaTrader 5 looks better, but whatever. There I actually take my trades, and there you can learn with fake money. You will learn later what you have to do with that, since a lot of people that clicked on this video probably know nothing about it. I will explain everything, as I said. And yeah, I also use forex calculator. This is just to, there are different apps. There's not like one app that is better than the other, but it's basically just to calculate your lot size, which means how much you want to risk, and you always want to risk 1% when trading. So this will calculate it for you, which is way easier. But I'm too stupid to type this in English right now. As I said, German, I hope this is right, whatever. And I also use Forex Factory. There you can see important news that will impact the market. And we, as a technical analysis trader, avoid that, since we trade, by the way, we trade Forex. If you want to learn crypto or something, this is completely different. So if you want to learn Forex, which most of the traders do, you should watch this video, but I'm not teaching you how to trade crypto or something, because a lot of people think crypto and stuff like that is the same, or stocks. I'm not teaching this. I'm teaching you purely Forex, which is the difference between euro and the US dollar, for example, and this is what most of the traders trade. So we will learn this here. Yeah. So get these apps. It's really useful. MetaTrader you should get on iPhone or like a phone. TradingView on PC, especially you can just use it in a browser. It doesn't really matter. Forex Calculator on your phone. Forex Factory is just a browser application, not application, but like a website. Again, you should use it on a website. And also, this will be an investment, but it's really the most important thing. This is the best investment you could make, is FX Replay. I'm not sponsored by them or something. It's just that FX Replay is the most important thing if you want to backtest and get experience way faster, because you can go back in the time basically, and the future will be hidden, so you can learn your stuff. And that's why I think it's a really good investment, but it's really expensive. It costs like $35 each month, so it's as I said, really expensive, but it's a must as a trader, I would say. Not a must, but you will get experience so much faster. It's like a time skip for 2 years or something. So I would really, really, you should get it, basically. So next I'm gonna explain the really simple things in a market, such as longs, shorts, and stuff like that. So if you wanna skip that and you already know that, just there is a timestamp below and skip that. A long just means that you get money if the market goes up, like this, for example. you get money if it goes up, and a short is you get money if the market goes down. Because a lot of people think you can only long, where you get money if the market goes up, but you can actually short. It's just like a bet. You can bet that the market will go down, or you can bet that the market will go up. So you get money if it goes up or down, depending on what you did. So you can just trade in both directions, right? So there are also bullish candles like this. Bullish candles are the green candles. You should write that down. Bullish candles, and these are bearish candles if they go down. This is also really easy. I'm gonna talk about why they look like that in the future, but that's for that. Also, yeah, I didn't talk about this yet. This is a thing called take profit and stop loss, which means if, let's say you enter here, wait, let's say you enter, wait, let me make an example right there. You enter here, have your stop loss here, and you take profit here on this point. This means that you take profits here, it's in the name. So your money gets automatically taken. You close your position and you get your money, and you just have no position open after that, or you automatically lose that money. Because let's say you take a trade and you want to sleep. You obviously don't want to watch at the market all the time. So there are certain price levels then that you will automatically sell. So your profits, as you can see here, won't go all the way down here, and you wake up with minus 20% on your account the next day. You know, so you should always use a take profit and a stop loss, always, even if you watch at the market. If you get experience in the market, you can maybe trade without a stop loss, but it's always recommended, especially for emotions, so you get automatically closing out. Because a lot of people think, oh wait, I'm gonna wait until it goes one more up and then I'm gonna actually go out of the trade. So if you use that, you won't have that emotional problems, and you should reduce the gambling factor as much as you can. So that's it about the really important things that you should know, I think. Yeah, there's nothing more. I think I will talk about it later if I find something, but there shouldn't be something. Okay, so I'm gonna talk about candles and why they look like that next. I'm gonna draw a candle real quick. We have like a thing like this, this, and this, right? So we use a candle because it represents market movement in that time in the smallest space possible. So let's say we go in the 5-minute time frame, then this means that the candle represents 5 minutes of price action, one candle. If we go in 1 hour, the candle represents 1 hour of price action. And why does it look like that? It's simple, because in those 5 minutes, price started here and ended here. So we have the body candle here, right? So this is the true path that it took. But we also, in those 5 minutes, went up here. This is the maximum that it reached, and this is the lowest point that it reached. So let's say price moved like this, right, like this, up here and closed here. Then the candle, the body, just shows this. Well, it's hard to draw, but you get the point. And the wicks, these are the small things that actually show where price went, but never stayed in this place. So it ended here again. So this is the start price, the end price, but this is the maximum that it reached and the lowest point that it reached. So in those 5 minutes, it went up there, and you see all of that information with just the candle. That's why we use candles in the market and not the like the line chart. Because with the line chart, you would only see that price went like this. But with the wicks, you already see that price actually went up here, giving us a lot of information about the market, because it at the end went down again, which means that there's selling pressure at the end. And this could mean something, you know? So this is all about candles, I think. This is the bullish candle, and this is the bearish candle. Wait, bearish candle is the red one. I talked about this, but I want to make it again. And with a bearish candle, the start price was here and the end price was here, by the way. So this is all about candles. Candles aren't that hard. You should understand that. I think just write it down, because if you don't write it down, you will probably forget it. And that's why it's really important to always write it down. Okay, so we now learned about candles, which are the really basics. So we're now gonna also talk about trends and market conditions. There are just 3 types of market conditions. Overall, there are like special types, but you know, the main types that we should know. There are uptrends, like this. and they're downtrends like this. So it's making a lower low, lower high, lower low, lower high. And this made a higher high, higher low, higher high, higher low. That's how you identify if it's an actual uptrend or downtrend. And there's one more where we actually stay on one place, which is consolidation. So we kind of stay in the box. It doesn't have to be perfect, but we kind of stay in the box. And you can mark it like this. This will be important in the future, but we're just gonna talk about the basics first. So I'm gonna show you a real life example, or like a real example of that. I want to see a really clear one, so you get the point. Okay, we can first draw it maybe. So we have this thing, I'm gonna actually draw it, and the real points. Obviously there's some small points I wanna show you overall. So we see higher high, higher low, higher high, higher low. First of all, I will give you some tasks that you should do. Before you continue to watch the video, go into TradingView, download the apps that I told you, and just go into the market and identify those things. Obviously, they're like kind of higher lows, higher high, higher lows here, but this is probably not important. If you go in higher time frames, you will see that it's only this. You should always look if it's a really high or low made, or if it's just like a small high or low in this thing, then it's probably just an uptrend in 4 hours in one time frame down. So first identify consolidation, 5 consolidations actually, 5 uptrends and 5 downtrends, and then you can continue to watch the video. You should really learn those things. You also see it here, 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 and up there. But I want to make an example of every type first, so you understand that, and then you can like make the task maybe. So here we see higher high, higher low, higher high, higher low, higher high, higher low. This is a downtrend, right? And now we search for consolidation. This is probably in lower time frames, so you see it a lot, because in higher time frames it's normally trendy. I want to see a good one here. You can see up here, down here, up here, up here. There's a lot of points, but it's never really going out of this area, so you can use this whole box to mark the consolidation. This is a really important skill, by the way, for the future, to identify consolidations, because there are some models that you should know, and they are based on those consolidations. I think that's it for trends. Yeah. Next, I'm gonna talk about, actually, there are different things that you can learn. There's support and resistance, there's smart money concept, they're like just different types that normal people trade. We are retail traders, we are not from the banks. The banks manipulate the market, but you should find something that repeats itself in the market that you can use, and there are different strategies. I'm gonna talk about smart money concept overall, but I wanna quickly go over support and resistance, since this is also important to understand if you wanna trade smart money concept. But if you like support and resistance more, you could also trade support and resistance as long as you really master those things. If you don't master those things, it's really useless, you know? So master one thing, concentrate on one thing. If you trade a smart money concept, that's completely fine. If you trade support resistance, that's completely fine. If you trade supply and demand, this is completely fine. Everything works in the market as long as it repeats itself in the market. If anyone insults your strategy, they're unprofitable. It's just a fact. If they don't understand that everything can work, they're unprofitable as fuck. They're just, maybe they have like 2 months of profitability, but you need to understand that everything works in the market, and all this toxicity coming from ICT dig riders, it's really insane. But I also watch ICT videos. I learned his concepts. His concepts work, but you shouldn't be deriding him, you know? So starting with support resistance, since you need to know this for smart money concept, but you also could also trade it. We clearly see here, it's support resistance is basically, we're going to talk about this first. Support resistance is basically just the thing, if you see market reacting on one price range twice, making like a resistance here, since price couldn't get through that level. Price will probably do the same if it goes back here, because there has to be a reason last time price went down. So if it goes back here, you place your take profit at another support level, because I think I actually never really traded support resistance. I just started with it, but I instantly forgot the terms. I think this is the resistance and this is the support. Like one is just the one for the downside, one is for the upside. So you place your TP at the next support that you see. So you have your stop loss with some breathing room to the upside on the thing. So if it retraces back there, you still have the trade. And then you just take the trade like this, that you enter here after a candle, and then you aim for the next support, maybe even for both of this. So this as well here. Wait, I have this and right. This as well, you can, by the way, take multiple TPs. You just enter twice, and then you take your first trade here and the second trade here, right? So this is the thing that smart money support resistance traders trade that you can also learn. I'm gonna show you real life examples real quick. By the way, I didn't talk about this yet. If you wanna take or if you wanna learn trading, you should first learn like one strategy that you want to do, and then you can take a demo account where you trade with fake money. And with fake money, you can learn those things, but you will never learn emotions, which is 80% of trading emotions. So you should trade on demo to understand those things, but then go into live with a small money account. So just take 100, 200 euro and just trade with that, even though it's not much. You wanna learn emotions, and you will have emotions even though it's a small account. That's just normal. So a real life example of this thing or this support resistance would be here. We see that it disrespected this level all the time. It always bounced back. So you could enter here and aim for the next resistance. You could enter here, here, and this time it didn't work. But that's just it. The market is about odds. You won't have a 100% win rate in the market. It's just a factor. That's just a fact. As a retail trader, you can't have a 100% win rate in the market. If you have programs, I think you can, but I never use them. I'm a price action trader, so I don't use programs to trade. I just use the pure price action that we see. So let's see. I think we can also talk about breakout. I don't really want to go into this as much. If you really want to learn spot resistance, you shouldn't be watching me, since I never mastered it and I don't want to give you like wrong things that you learned. Basically, breakout is that if we have like this thing here once again and it breaks out of this area, retesting this support basically, then this whole thing flips. Then this is actually the point where you enter. So this is a breakout strategy that you can enter off, and you could also be profitable with this. As I said multiple times now, I really want to get that into your brain. You can trade anything you want, and yeah, that's it for support resistance. I think that was it was really small, but we also see it here. I wanted to show you examples. One thing I want to show you though, if you trade support resistance like this, where you just have one thing, see that thing as an area. So if you go in high time frames, you have the support area, not the support line. This works way better than the line. This is what I noticed when I traded support resistance. But we're not gonna talk about this as much. As I said, I'm not an expert in support resistance, even though you should know that if you trade smart money concepts. But I like smart money concepts way more. I didn't even talk about forex pairs yet. I think I did, but not really deep. So let's say we trade Euro US dollar, which means Euro is against my typing and my drawing is shit because I have a mouse. Wait, I'm gonna type it actually, this is better I think. So forex pairs are always made out of two currencies. So we first have the Euro, for example, Euro US dollar. So we have Euro against US dollar. Means if Euro is stronger or it's more expensive basically, then Euro will go up. But if US dollar gets expensive as well, it will be on one line. If Euro is expensive and US dollar goes down, this means that it will have an impulsive move to the upside. And if US dollar gets stronger and US dollar stays the same, it will go up. It will go down. Sorry. And if US dollar gets stronger and US dollar, this is too much. Euro gets weaker and the US dollar gets stronger, it will also go down here. It's always the first currency against the other currency. And you should always trade pairs with a lot of volume. Pairs are just these. You should trade these, I think, at the beginning. Even though a lot of people say that you should focus on one pair, which makes no sense. The psychology is the same in every pair. You can trade whatever you want. It doesn't matter. And if you I don't know, you backtest this and you like it more, then trade it. You shouldn't be focusing on the main pairs here, and you should also trade multi-pairs at the same time. Because if you see a good setup here and you miss that because it's not actually, look, this is a clean trade I took, but whatever. Um, you shouldn't focus on one pair because you will miss out on a lot of setups. If I would only focus on one pair, I would probably find only one valid setup in 8 days, which is stupid. So I have multiple pairs where I look in. If I find a perfect example of a pair, you can also trade it. Never restrict yourself to one pair. The psychology is the same in every pair. It's all about volume. The only difference between euro and US dollar and Australian dollar, US dollar is the volume. There's more volume in one pair, so it moves more, but it doesn't mean that you can't trade the other pairs. So have like your main pairs that you normally trade, but if you're like just looking at the charts and you find something here, you can also trade it. Here I lost, which happens, okay? But you can just also trade every pair that you want. Obviously, you shouldn't be trading US dollar against fucking Turkey thing. There's no volume, as you can see here. This is completely stupid. You shouldn't trade this. I still have it here because I don't know. I just mark out the things. But you can trade anything that has volume. Okay, you get my point. So I think this was everything I need to say about the basics. This was one thing I forgot about the basics. That's really dumb, but yeah. So the next thing is that actually I don't even know where to start. There's so much, but I want to really keep it as short as possible, but also get it into your mind, which is what is important, because there will be a lot of people. Obviously, you don't have to trust me. I'm also just a young person, let's just say this, and I only have experience from 1 year of trading, but I still know what I'm doing. I have the certification. I passed my first funnel that I ever got, and yeah, it's just the beginning of my journey. I really want to grow this YouTube, help a lot of people, and just get them to trading as well, because trading is such a good. It's not only teaching you trading, it's a lot of things that you learn in trading. You learn about yourself because it's really hard for emotions, okay? It's really hard for emotions. You will learn things like if you're not patient enough, you won't make money if the market in the market. If you're a gambling addict, you won't make money in the market. Everything that a bad psychology thing that human can do will punish you. Trading will punish you for this, and you need to get better as a person to get better as a trader. So trading will learn you discipline, patience, not gambling, doing learning. Trading will learn you everything, and that's why I think trading is one of the best hustles, or not hustles. I hate this word. I think it's really cringe, but I really like trading because of that factor. Okay, so that's what I wanted to say first. So you won't learn much about patience and stuff like this in this video because I don't really know how to teach you those things. It's just something that you learn, but there are surely some videos you can watch. I won't go over that. It's 80% of trading emotions, but I will only teach you um, technical analysis, things that you need to learn, and stuff like this because it's also important, even though there are different important things. I wanted to go over market conditions once again because I forgot things, I think. There's different market conditions, like this, we talked about this, like the consolidation. Oops, it's really bad drawn. Consolidation, downtrend. Bro, why am I so bad at drawing? Okay. Downtrend and uptrend, right? We have those things. And we also have things like this, where we have a uptrend that is really consolidating a lot. This is also kind of market condition that you need to learn, and it happens as well. By the way, every market condition happens in every pair. That's why people saying that you should focus on one pair is stupid. Everything happens. It's just sometimes this happens more rarely because there's more volume. Doesn't mean it won't happen. So, and you should be able to trade every condition as a trader. So just to learn how to trade every pair, and you will get better as a trader overall, and you won't have a lot of or more losing months than other people. And yeah, so starting with the first confirmation from my strategy, or not my strategy, my concepts that I use. My strategy is something else, but the concepts that I use. Liquidity. We talked about support and resistance earlier, where we have the resistance here, right? And they enter after seeing a bounce again. which happens here. What happens here is basically that they enter here, making their stop loss here. So a lot of stop losses with a really obvious support and resistance bounce will be here. So what will happen if a market takes those out? It will automatically sell since they have a stop loss right there, which means market will push price impulsively down after activating this price area where a lot of people actually have their stop loss. Since a lot of people are trading spot and resistance, like 95% of the market, of the market's retail traders are trading spot and resistance, I think, or something like this. I don't know the real numbers, but the banks take those people out so they can make big moves to the opposite direction. They have so much money, they can't even fill their orders. They want to buy something or something like that, and they can't fill their orders because they have too much money and there are not enough orders in the market. Even though it's kind of bullshit what I'm talking right now. It's stupid that I said this now, but it's bullshit. There's a different reason this works, but this is the easiest how I can explain it to beginner traders, because overall this whole thing is bullshit. It's just explained this way for beginners, but yeah, I'm gonna teach you this way because it's easier to understand than the other thing that I can maybe talk about in a different video. But yeah, I'm gonna explain it like this. So we have an impulsive down move here, then, and a lot of people when they see impulsive moves, they enter on this. So we have an even more impulsive move. Then we have a quick retracement, and all the time, if the market makes an impulsive move, there will be a retracement. It's a 100% thing because people want to secure their profits. So we always have a quick retracement after impulsive move, even if it takes a bit, but there will be one. So we have the impulsive move, retracement, and then this is the point where we normally want to enter. But this concept with the stop losses, this is called liquidity, and this sweep or this impulsive up move that takes out the liquidity is a liquidity sweep. So we have two things that you should write down right now. Liquidity, liquidity sweep. And liquidity is the most important thing. If you master liquidity and one more confirmation, you can be profitable already if you master emotions as well, obviously. But this is so important and you need to understand it. If you don't understand it, you can just text me on Discord or something. I have a Discord server. I will help you. I helped a lot of people and I'm here to help. Otherwise, I wouldn't be making this video. I don't even get money for this video, bro. I just make this video to help people. Obviously, my goal is to grow my YouTube, but I could wait and make this video in the moment I have enough subs that I will actually get a lot of money through this video. But I wanted to make it right now since I have a lot of people asking me in my DMs on how to start trading and stuff like that. So I will just make the video right now. I appreciate if you sub for this. I would really appreciate it. But yeah, I'm also like doing clickbait and shit. Obviously, I want to grow my YouTube because I wouldn't make this completely for free. No one makes it for free. I want to keep it real. Obviously, I want to grow my YouTube so I have something more safe doing on the side, even though trading is my main income. But trading won't be forever. At some point, trading won't work anymore. Market conditions change, and maybe I'm not built for this market conditions anymore. Because all my experience is shit. Then, if in 5 years RE will go over the market and market conditions will change, so I have to adapt to the market, and maybe I won't be profitable anymore. So I want to make something on the side that I can make more secure money with, which is content creation. So obviously, my goal is to grow my YouTube, but I also want to help people out that started trading because I just think a lot of people are gatekeeping, which is completely stupid. It's market. It's already there are a lot of people unprofitable, right? You have to gatekeep for 4 people or something that will be profitable from the people that you will actually teach, because market is hard and you won't make money if you don't put the time into it. So why won't you just teach the few people that will actually put the time into it? Even if this video gets like 2K views or something, there will maybe be 3 persons that will be profitable, because you have to put the time into it. And it's not something that you have to really put your time into it. It's not something you can do on the side. It's not, oh, okay, I will learn it so I make 100 euros on the side. No, this is bullshit. You have to if you're in a moment you make money in the market, you scale it so much that you will be rich. This is not even a question. If you can make consistent money in the market, you will be rich. It's only about getting this edge that you can actually make money in the market. So don't ever say that you want to learn trading to make money on the side. It has to be your main thing that you want to learn. If you don't put the time into it, you won't be profitable. Don't even start thinking about making money if you don't put the time into it. And don't start a funded account if you're not profitable. This is just the advice from me, because you will lose money in the market. And if you don't want to put the time into it, the money that you lose won't teach you anything. But if you lose and you want to continue and you don't stop after losing, this is when you get profitable. If you learn from these losses, journal your trades, which is also really important, by the way. You should always journal your trades, which means you just type down what you did wrong and what happened, what took you out. You find similarities in your losses, you find similarities in your wins, write them down as well. Go into the market, go over your notes. You see, oh, last time it made this and I entered and I lost. You will just avoid it. This is how you refine your strategy. This is how you get profitable in the market. Okay? Yeah, this is something I wanted to bro on. I'm getting distracted, but I've seen a lot of people in trading and I learned a lot of things, and I see how people wanna make money in the market, even though it's completely stupid. I really hope you get profitable from this. I really hope I can help you with this video. But if you don't start doing something from your own, you won't make money. It's just the fact. So yeah. Next thing. Wait, let me go over my notes. I mean, we can start talking about fair value gaps. I think they're easy to understand, and they're one of. Oh no, no. Let's actually start with breaker structure. So breaker structure is simply we have an uptrend, right? And it closes above this. And here it closes above this again. This is a breaker structure, which indicates that we just made a higher high, higher low, and now we made a break through this level, probably going for the next higher high. And this is normally used for confirmation when market wants to reversal. So let's say obviously you can also use it like this, but normally the best way to use it is if we want to predict a reversal. So we have like a downtrend, and you see it breaking here, then this is the best point to enter, because it's normally if a reversal happens, it has at least like 2 pumps or something like this. So we can enter here and exit here, you know? So this is the best point to enter, catching those reversals, which happens more often with smart money concept than support and resistance. And with support and resistance, you normally want to continue with the trend, I think. I'm not even sure, but no, I don't trade it. But yeah. So breaker structure would be, by the way, I have videos on every confirmation in my YouTube if you wanna go over that again. I wanna show you a really clean example because it's always better. Okay, bro, there's so much wicks. I have to go in 5 minutes. Okay, here we close below this. Here, telling me this was the lower high made, this was the lower low. We're gonna go for the lower low once again now. And then we are about to close above this. And I don't consider the wicks. We only want to watch at the body, because if the time frame is higher, it's more accurate. And if you look at the wicks, you're basically looking at lower time frames, which I don't like. So you always wait for break structure above the real body and not the wick. So don't look at the wicks. But if you see a lot of like insane wicks like this, you should wait at least a little bit. So let's say we have a thing like this, we should always wait for at least here to break. It's just experience that you have to learn. You will learn it. But yeah, here also we break below this. We made a low here and we made this again. We always want to see if there was an up candle. We want to see at least one down candle and then an up candle again. If you see a down candle and down candle, you can't see this as a break structure. You have to down candle, down candle, break structure. Always. There has to be in the opposite direction the candle once again. Then it's like valid, you know. So now we actually talk about fair value gaps, right? Yeah. Fair value gaps are also simple to explain. If we have an impulsive move and we have an area where price went only once, it only went once through that, then this is our fair value gap. And if we go back into this fair value gap, there has to be a reason that price only went there once, impulsively like that. There has to be in this price area, let's say from like this to here, in this 1.08165 to 1.08186, there has to be a reason that in this price range market went up, and it will probably do the same. So you can use it with other confirmations in combination to kind of find the thing here. So let's say in higher time frames there was a fair value gap created, there was liquidity built up here, you go into this fair value gap, and then you can wait for a break structure here, and then you can also already enter. And this is our confirmation, and this is how you see it in the market. By the way, I don't think I talked about liquidity as much as I should have, because liquidity is really important. I will talk about this later in the video, I think. So yeah, and how do you identify this in the market? You want to see price where only the real body went through and there was no wick going into it. So here, first body, this was the thing, real body went through, and the third candle, and this is the wick. So this is the area. We don't see the wick because price went back into this area, means this is not a valid fair value gap. This is the valid fair value gap, so in this area. Obviously, this alone won't change, this alone you can't trade off, but you can see that price struggles to go through that, but then it goes through that, which normally, by the way, indicates if it disrespects the fair value gap, that price wants to really go into a different direction. If it disrespects the fair value gap like this, it's probably going for even higher things, probably for this liquidity up here, because this is a spike liquidity, because this is in this last time you won't see it, or it didn't go into this thing like a lot of times. You see here a lot of times it happened here, then it spiked here, then it went down again. So this is a really good liquidity that we see here, and if it disrespects the fair value gap like this, it's probably hunting for something up here, which we will learn later as well. But this is a fair value gap basically. I want to show you an example that actually worked out, because it's really stupid it didn't work out here. Here, you can see it. This is the fair value gap made, because first candle here, second candle here, real body, then we went up here, so this is not valid anymore, only this area is valid, and we have the fair value gap right here, price went into this fair value gap, and then actually retraced back down. And after the fair value gap is used once, it's mitigated, means it's not valid anymore, or less valid. You shouldn't trade off that anymore then. You should only do it if it's not mitigated. And here you can see it went through, because it was mitigated. And then we see that price made the fair value gap here once again. It tapped into it here. It's even though it's only tapped into it really like it's a really small area, it's still valid. And then we completely went up. We tapped into it again. This time it worked out, but you should only look at not mitigated ones. You know. So this is a fair value gap. I'm gonna next talk about order blocks actually. There's, as I said, a lot of information, and you shouldn't be looking all of this in one session. Just make notes, learn those things, have examples in the market. If you have questions, just ask me in the comment section or ask me on Discord, I will help. And yeah, so next thing we're gonna talk about is order blocks. Order blocks are just the point where price went down, like this move. Let's say we have like this, then we have like this down move, and this causes a really impulsive up move. And this down move that caused a really impulsive up move, normally combined with a liquidity sweep, which is more or better, then you can mark this last down move. Let's say it went up here, then you take this as a high and this as a low as an order block. Same thing as fair value gap. This price area caused, especially this price range, so you can make this as even more intense, especially this price range down here caused the market to completely impulsively go up. So there has to be a reason for that. Price goes back into that, it goes up again. This is called order block, but you can also call it supply and demand, since supply and demand is simply the same. But yeah, so let's see if I don't really like order blocks that much, but I see it. By the way, here's the liquidity sweep kind of, even though it's not good enough, so I'm not gonna show that. I want us to see a clean example of that. Let's see. I don't really see a clean example of that right now. I want to see like a really clean example. Obviously, I see bad examples that worked out but not as clean. I mean, here, I guess. Those wicks, especially if we go in lower time frames, you will see that there's always wicks in higher time frames then, because it went down and instantly up. So this causes a wick in higher time frames. So this wick area is normally the order block, and we can mark the whole wick area here. take it, and you see it goes back into that, and instantly you see the big candle going out of that, which means this is a valid order block, and then it went up here. And also here's, I think, an order block, even though it's not as good. You see it here. Yeah, that's already it. I think 2 order blocks. It's really hard to explain because it's a lot about market experience, and seeing those things is you just have to get a feeling for it when it's valid or not. There are also breaker blocks, by the way. I call them breaker blocks. I think they're not called breaker blocks, but I just think they're fine. And also the gaps here. You see the gaps at weekend because price opens and the people that like manage those stuff hedge just say that price will start here. So we have this volume gap right there, which acts like a fair value gap, but a fair value gap that doesn't care about if it's mitigated or not. If it breaks through though, so it's mitigated basically. So here you can see bounce, 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 bounce. It goes through and now it doesn't matter anymore. But yeah, this is a volume gap. Can also write that down. That was a really quick one. Yeah, that's kind of it with that. A breaker block is just we have impulsive up move, and in this impulsive up move there's like a really quick down move and instantly up again. So we can take this, and if it goes back here, yeah, that's it. This is everything about that, I think. There's nothing more. Yeah, obviously I don't go in detail in this video, I just wanna go over it real quick to show you. Here also, by the way, we have an order block here right now. This area reacted to it and went up perfectly. Actually, this is a really good example. But yeah, I'm gonna quickly go over everything. If you wanna go in detail, just write down everything you just heard about that, learn about that, and then you can go into each video that I made where I talk about each confirmations at once. But yeah, I think that's it with order blocks. So next thing we're gonna talk about is Fibonacci retracement. I think that's also valid. I will talk about this, even though it's more like a support resistance thing. I really like to do this. If we have an impulsive uptrend, I talked about that they want to secure their profit so it goes down again, right? And what a Fibonacci basically is to take the lowest point to the highest point that it made here, and then you want to see you can copy my things by the way here if you want, my settings. It's German, but you will see it. No? So we have this, and this is just backtested a lot of times. There's basically, it's backtested that this is the best point. If it goes here and has a reaction on this golden area, like the one 0.618 to 0.68, you know, this is the golden area. If it goes here and actually shows a reaction like a breaker structure, it's really good, especially if you combine it with a fair value gap on that point. But this point is also valid, the one above. You always want to wait for the 50% mark, since this is called equilibrium or something like this. I never really learned it. This is just logical, because price always want to be bought in either premium or discount. Means if you look at the market as a complete beginner without knowing anything, you will always see like this, and a lot of people see, oh, it's down, it's probably going up. This is discount, right? And here we see, oh, market is up, it will probably go down again. So this is premium. So you want to short here. You always want to go above the 50% mark. So if it's below the 50% mark of the overall current price movement, you always want to buy, and if it's above it, you always want to sell. This is equilibrium, this is the 50% mark that you can use. So let's say we have like this movement here. We see that here we always want to wait. If we want to go for buys, we want to look for buys here. But if it goes above this, we want to look for shorts here, because this is premium, this is discount. This is already everything you need to know about Fibonacci and equilibrium, I think. I really go over it really quick, but it's really not. A lot of people are just overcomplicating things for no reason. It's really not that hard. It's just experience about which one is valid or not. The rest is completely useless. I always hate when people need to have this fancy names for the things and make it completely overcomplicated for no reason. But yeah, that's why I want to keep it simple. Mm, I think that's nearly everything it from the confirmation side here. It's all about combining those things now. But yeah, actually no, I didn't talk about volume yet. Volume is, a lot of people think if there's impulsive move, there's a lot of volume, which is wrong. Volume just means that there are a lot of people trading, so there's different opinions in the market. If there's less volume, there's different opinions. There's less opinions in the market. Means it's probably one-sided. But if there's a lot of opinions in the market, it's more of a consolidation, going up and down, because people say, oh no, it will go up. Oh no, it will go down, which means there's a lot of volume. So if it goes into this area, volume area, we can use this tool here and clear from the consolidation to here, we can take it, right? And then we will, I can't show it here because it doesn't do it, but here you see there's a volume peak area, the point with the most volume in this area. And you normally want to see this as a support and resistance line, kind of. So if it goes here, it will either consolidate around it, or it will make an impulsive move down because there's just not enough opinions right now, but it has a strong, it's just an area that is strong because last time there was a lot of volume for a reason, because in this price range there was a lot of opinions. But if it goes down then with an impulsive move like this, going here and then impulsive move down, it's more likely to actually continue to go down because it broke out of this area where it consolidates. So let's say we have the consolidation here, it breaks out of this area of consolidation, then it's more likely to actually continue this because the one-sided trader started the trend, the impulsive trend, that will now indicate a new trend in the market. And normally I want to combine it with Fibonacci. So we have the impulsive move here, a little bit down, then I want to now, because this is the first lower low made, we want to now catch the lower high, which means we take our Fibonacci again, we wait for it to go into the golden zone with a like a fair value gap or something, and maybe even a low time frame volume area once again. Then you wait for it to go back into here, break of structure, liquidity sweep, and then you enter here, maybe make your take profit here and here for the liquidity, and then you make your profits, you know? This is really easy. And this is always already what you need to know. You normally always want to place it at consolidation. So you identify the consolidations just like this. We have the consolidation here. So here it started where it consolidated and it ended kind of here because you see impulsive moves. So here you see a perfect example. It breaks out of this area, the perfect point here, instantly impulsive out, which indicates a new trend. Now it kind of goes here and now here. This would probably be the 50% zone. Let's see from here to here. Yeah, here it is above the 50% here and actually reacts to the golden zone right there. Here also, it bounced around that area a lot. Here, here, here. It always went down again, and you could have traded each time. Here, this was the perfect entry, by the way. Here was the bounce of this volume area, and here it goes into this golden zone for the first time, taking liquidity right there. As you can see here, we have two bounce here, taking the liquidity. Back of structure in lower time frames 100%. You aim for this liquidity, and this liquidity. Each would have hit, and you would have made so much money already if you have the right account. You could have legit made, if I enter here, golden zone, make my stop loss above the golden zone with some breathing room normally here, and then aim for this low. It's a 1 to 3.7 risk reward. You could have risked on a 10k funded account, you could have risked your 100 euro, or even if you have a 100k funded account, which is the same, it's the same difficulty. By the way, if I started with 100k, I would have 100k right now, because it's the same restrictions that you need to pass with. And then I would have risked 1k and gained 3.7k just from that. And it's not hard. It's not hard to understand. It's volume bounce here. We wait for the retrace into the golden zone. We see the golden zone reaction. We see a break structure in low time frame. We see the liquidity sweep, combining everything. It's just perfectly aligning with every confirmation that we have. And then we enter. Obviously, it's not 100%, and that's the hard part. You need to have your emotions on point. If you lose the trade and you just revenge trade and you go back into the trade because, oh, now it will work. Now, this is the. If you lose a trade, don't look at the chart for one day or something. I normally wait, and then you will fix your emotions. This could have made you so much money, and it's not complicated, right? But yeah, that's kind of it with volume. And I think this is already it with the important confirmations that I use. There are a lot of confirmations that you don't need to learn. It's all useless, I think, because you just need to master the confirmations that you want to use. These are the confirmations I mainly use, and I kind of mastered them, even though order blocks I rarely use, but it's whatever. So now I'm going to talk about a strategy that you can do, which is really easy, and also about kill zones, kind of, because there are a few times in the market with more volume. If I have, do I have German times? Yes. Okay, just you have to look at German times and see how much or how the times are different, different. My English is down. I talked for 43 minutes. I talked non-stop English. It's really hard to translate. I never really had that much experience with English. I hope it's still understandable. But yeah. But what you basically do is, this is Asia Open, 1 a.m. German times. Asia Open means it's 8 a.m. in Asia. So normally this is the time where a lot of people trade. So there's more volume in the market. But we don't trade Asia Open. This is stupid. We wait basically for London Open, which is for Germans even better because it's 9 a.m. there. London Open. London is 1 hour behind us in Germany, so it's 8 a.m. there. So there's the most volume of the day. So we have like this made, and then there's a lot of volume. If there's a lot of volume, there's a lot of retail traders, there's a lot of liquidity, there's a lot of stop losses that could taken out. So what happens now is we have the high and low of Asia here. We have probably points of support and resistance there, or liquidity there. It's even better if it has like 2 bounces here. It's probably hunts for the liquidity now because there's a lot of volume. It's probably going for this here, making a new or a perfect low, a lot of stop losses, banks take them out. We have a clear sweep, breaking structure here. We have the retracement into fair value gap here, and then we aim for the next liquidity, which would be up here, right? And this is all you have to do. This is a strategy that is really known. That's why I don't like it, by the way. I don't like trading something that is known in the market because you need to be individual in the market to actually make money. If you're not individual, you're probably yourself liquidity that you will get stopped out because there are a lot of people trading the same trade. But here you see we had a prayer structure combined with a fair value gap creation, which is the perfect thing. So you write down, you make a trading plan. This is all you have to do. You have your trading plan. You wait for a sweep, wait for a sweep of Asia low. No, actually, wait, I'm gonna start from first. Mark Asia high and Asia low. You make it from 1 a.m. to 9 a.m. Mark the highest point, simple, lowest point. You wait for, I can't have sweep of the high or low. Wait for a sweep right there. Then you wait for a BOS that have to, or has, I don't know, to create a fair value gap. Here, fair value creation. You wait for a retracement back into the fair value gap und pref in golden zone. In combination with a Fibonacci retracement, it would be perfect if it's actually lining, and it has to go below the 0.5% mark. You can write it down. I don't write down everything. You should write down how much you want to risk and stuff like that as well. But yeah, I'm not talking about this in this video about trading plan. And perfectly would be if it reacts to the golden zone as well. So we have this golden zone reaction, then we have a prayer structure in lower time frames, in, I don't know, like 3 minutes or something. And then you enter SL below the sweep, take profit on Asia high, low, depends on what you traded. If you traded off the low sweep, then you aim for the high. If the opposite, then you do the opposite, obviously, right? It's not that complicated. So you have a thing here, you see the breaker structure in 3 minutes, you make your stop loss here below the sweep, you aim for the high, we have a 1-2 risk reward, and that's already it there. If you mastered it and learn when it's not valid or when it's valid, then then you will be profitable. Just journal it, write down when you lost with this strategy, and write down when you won. And then you just find similarities and do that, and you can make a lot of money in the market. Which is so stupid because it's so much easier than or not easier, but it's so much more comfortable than working all day to make not even close as much money as a trader. It's just that you need to risk something in life. You risk a lot of time, a lot of time, more than 3 to 4K hours, like 4,000 hours, and it's not 100% it will make money. But if you're at that point where you make money, everything that you did before will be worth it, and it's just a fact. So I really would tell you to put the time into it, and if you want to make money, then really stick to it. Just if you want to, if you already know you're not gonna put the time into it, don't even start. But if you know that you want to put the time into it, really do it. Your whole day should be full of trading. You only do trading. You backtest. In your free time, you backtest all the time, and it will be worth it at the end. You can make so much money in the market, okay? It will be worth it, trust me. So that's it. I think that's already it for the video, since I don't really know what to talk about. There's a lot of stupid things. That I could talk about, but I don't want to stretch the video because it's already really long. I hope you get everything that I talked about. And if you have any questions, just ask me, right? And I'm thinking about if I have anything left, but there's not much left. Maybe I could talk about one more strategy, I guess. It's not really that important, but I'm gonna make it real quick. It's not that long. So you normally want to see a high time frame volume area that I talked about, so high time frame consolidation, and then you want to see a low time frame consolidation. If it matches perfectly, if there's a high time frame, if there's a consolidation in the volume peak, normally if it breaks through, it changes. You know. So let's say we have like this. You think this is the bounce, but it actually breaks through. Then this is actually now different, the opposite. So what you want to see is it goes through the low time frame thing, reacting to this. This is the perfect setup area. This is what I trade. We see impulsive move going through this low time frame zone here, and making impulsive move of that, and then bouncing on this area, fair value gap, golden zone, and the retracement from here, golden zone, fair value gap, and the low time frame thing. And then I just aim for this, and it's like a 1 to 3 risk reward. This is my perfect setup, and it's not really complicated. But yeah, this is it. Hope you liked the video. If you like it, like and subscribe. I would really appreciate it because it's probably gonna be so hard to edit this shit. I'm not even in editing yet. It's just the first time I did. But yeah, you understand it. I'm also hosting a lot of giveaways. So I'm giving away 100 accounts. It's in my Discord. Join there if you have any questions. And yeah, see you next time. Bye bye.